Imagine saving over $20,000 in tax just by using these 4 simple tax hacks. Well, that's actually what my accountant saved me this year alone, because after recording over 2,100 property podcasts and interviewing some of the top property accountants in the country, I've learned exactly how savvy Kiwis keep more of what they earn. Now, I'm not a tax accountant, so I come at this as a regular person, a regular investor, but I do part own an accounting company, so I see these 4 tax strategies in action every single day. Hey friends, welcome back to the channel. I'm Ed, an economist and property investor, and in this video, you're going to learn the 4 tax hacks that every property investor needs in 2025, how much you could potentially save, and whether this is even ethical. Now, tax hack number 1 could save you up to 16.5 grand over the long term of your investment property. And it all comes down to your washing machine, your carpet, even your driveway. Now, let me explain. If you want to reduce your tax legally on your investment properties, you basically have 2 options. You can either reduce your taxable profit or you can reduce your tax rate. Now, to reduce your taxable profit, you either increase your taxable expenses or you lower your taxable income. And most of you might be thinking, but if I lower my profit, sure, I'll pay less tax, but then I'll also be making less money. So isn't this kind of like cutting off your nose to spite your face? Well, that's why I said lowering your taxable income or raising your taxable expenses. And that's where chattel depreciation comes in. Because when you buy property, it doesn't just come with the 4 walls and a roof. It comes with a whole heap of stuff within the house. And over time, that stuff, like your washing machine, your carpet, and yes, even your driveway, that will all wear out and you'll gradually need to replace them. Now, you don't have to pay for that wear and tear straight away, but you can still count that as a taxable expense and use it to lower your tax bill. So let's say you've got over 50 grand worth of chattels in a house. Over time, you could easily claim 16.5 grand worth of tax savings. And this applies to lots of things like heat pumps or curtains, the oven, anything that isn't bolted down or part of the house itself. But you can only get the full value from this tax hack if you get a chattel valuation, which a lot of investors just skip and don't bother doing. But if you did it, it could save you 16.5 grand in tax. And because all of this information, it's really quite nerdy and there are a lot of numbers, you can download this cheat sheet with all 4 tax hacks. That way you don't have to worry about taking lots of notes or following every single number. The link's down in the description. Now, over the next 10 years, this next tax hack could save you almost 7 grand in tax. And it's one that many property investors, they tend to overlook, which is sometimes you will pay some of the expenses for your investment property out of your own pocket, and then some investors forget to put them in their tax return. And what that effectively means is that your expenses look lower than they really are, and you end up paying more tax. So how could this work? Well, maybe you've got a cell phone, a mobile phone. Now, you were going to pay for this anyway because you use it for personal use, but maybe you also use your cell phone to call up your tenants. Well, that means that you're using that phone for business purposes, so part of that cost, again, which you were going to pay anyway, is now tax deductible. Well, what about your home office? Maybe you manage the rent, you manage the paperwork from home, and you were going to pay your mortgage interest anyway, you were going to pay your rates anyway, but now you've got a home office, part of it is for business purposes, so some of that could be tax deductible if you're managing properties yourself. What about your property investor magazine or maybe some tickets to a property investor conference? Well, you might have paid it anyway out of your own pocket, but now you're an investor, so this is a business expense and you can use that to then lower your tax. Now, I'm not saying you go nuts and try and claim your trip to Fiji, but if it's clearly linked to your rental properties, to your rental activity, it's worth having a conversation about with your accountant, because all up, that could be $1,900 worth of expenses a year, saving you $627 a year in tax. And over 10 years, that could easily be 6 or 7 grand in your pocket. So that takes us up to a total of 23.5 grand worth of tax saved so far just from the first 2 tax hacks. And you might listen to these and think, hang on, is this ethical? I get that it's legal, but is it ethical? Don't we want property investors to pay more tax? And the thing is that talking about tax can get really emotional. If you're paying a lot of tax, you generally want to pay less. And if you're earning a bit less and you're not paying as much tax, generally you want other people to chip in more. And look, I'm calling these tax hacks today, but they're not really hacks, are they? It's just following the rules. And that's what I'm really talking about here, making sure you are following the tax rules to their fullest extent, using the rules that are there to pay less tax compared to if you didn't know what the rules were and then accidentally paying more tax. So all I'm saying is don't pay more tax than you legally need to, and don't tip the tax man, because some people do overpay their taxes. They do pay more than they need to because they don't know the rules. And if you don't like the rules, if you don't like the system, that's okay too. My goal here at Opes isn't to change the system, it's to tell you how it works so that you can either make smarter financial decisions, or if you don't like property investors, at least you now know what you're fighting against, because people often don't talk about tax this plainly online. On to our third tax hack, which could save you $28,000 or more in tax over the next 10 years. You see, here in New Zealand, we love a family trust. In fact, we have the most family trusts per capita in the world. Now, so far, a lot of our tax hacks have been about increasing your expenses to lower your tax, but this one is about lowering your tax rate. Now, the trust tax rate, if it's earning more than 10 grand a year, is a flat 39%, right? You can't change that. But trusts do give you a lot of control over who pays the tax and how you divvy up the income. Now, stick with me on this because this is really important. A trust doesn't reduce the total tax, but it does give you control over who pays that tax. So let's say that you and your partner own a few rental properties and you earn a big salary, so you get taxed at 39% a year. But your partner is staying at home and they're looking after the kids, so they're not working right now. Well, their tax rate is currently 10.5%. And let's say you've got that family trust, you own a couple of rental properties in there, and that trust makes 15 grand a year from rental profits. Now, if you think, well, hang on, I bought these investment properties, I'm the higher income earner, so I'm going to pay out all of that money to myself. Well, that's income, and you're going to pay 39% in tax because of that, which means you're going to pay a total of $5,850 to the IRD, which means that you take home just over $9,000 in that scenario. But remember, your partner is the stay-at-home parent, so they're not earning anything right now. Well, what would happen if you didn't pay all of the $15,000 to yourself? What if you split it 50-50 with your partner? Well, then the total amount of tax that is paid goes down to $3,700. That's because half of it is taxed at a much, much lower rate, and so you take home more money. But hang on, what if the trust pays all of the income to the lower income earner? All of a sudden, you're not paying over 5 grand in tax anymore. You're now only paying $1,500 or $1,600 in tax. And rather than taking roughly 9 grand, you're now taking home 13 grand into the household. And this works because of a quirk in our income tax rules where we are all taxed as individuals rather than households. So a household where one person earns 180 grand a year pays more tax than if you had 2 people earning 90 grand a year. It's the same amount of income, but they pay less tax. And if you don't like that property investors can use these rules, then get in a time machine and vote for the man in a bow tie, because he tried to change the law back in 2010 and make it so that everyone was taxed as households, but he couldn't get the votes. Now, if you add up the tax saved so far, that can take us up to 51.5K worth of tax saved over 10 years. And you should also know that even if you use all these tax hacks, they might not work immediately. I mean, back in the good old days, if your investment property lost 10 grand a year and you earned 100 grand from your job, then the IRD would look at it like you only made 90 grand a year from your job, and so you could get a tax refund on that extra 10K that you'd paid from your salary. But that all changed in 2019 with the ring fencing rules, which came in under Jacinda Ardern's Labour government. And what that means is if your property is currently making a tax loss, you can still save a lot of tax, but you only start saving the cash once your properties make money in the future. So when your rent goes up and you eventually make positive cash flow. So these tax saving strategies won't make a difference to everyone watching this video right now, but, and this is quite important, it doesn't mean you should just ignore them, because you can still save tens of thousands of dollars over the long term. And just before I show you the last tax hack, don't forget to download that tax hack cheat sheet so you can remind yourself of what all of these tax hacks are without having to watch the whole video again. The link's down in the description. Now the next one's a bit of a head scratcher, but stick with me on this because it could save you around $7,000 over the next 10 years. And it's all about paying down the right loan first, because often we say to investors, put your investment property mortgage on interest only and focus on smashing down your home mortgage first. And there's a very good tax reason why. So let's say you've got two $500,000 loans. So one is on your own home and the other one is on an investment property. Now you could pay down both at the same time, and that is what some investors do. But here's the catch. Your home loan isn't tax deductible, but your investment home loan is. And so if you make the investment loan interest only and throw all of your repayments onto your home loan, here's what would happen. You would end up paying the same amount to the bank, about $644,000 over 10 years. You would pay off the same amount of debt, about $186,000. But here's the difference. About $21,000 is the extra interest deductions you would have. And what that means is that you get about an extra $7,000 worth of tax benefit. In other words, you save $7,000 in tax. It's the same amount of debt paid down. It's the same amount of repayments, but you keep more in your own pocket. And that's what people mean when they say that investors can structure their affairs to pay less tax. And look, it's not shady, it's not against the rules, it's using the rules to their fullest extent and just setting up your financial scenario in the most efficient, in the most intelligent way. And doing things that you might not initially think of to put yourself in a better position. And let's be real, if this were really that sneaky, would I be saying this all on YouTube? The reality is you don't get any tax deductions on your home mortgage, so pay that one off first before you start tackling your investment debt. And this is the actual tactic that my accountant is using with me to save around $20,000 a year in tax. So if you add it all up, that's about $58,500 worth of tax saved over 10 years if you used all four of these tax hacks and they apply to your scenario. Now, the truth is though, that even the best tax strategy won't help if the deal itself, if the property itself is flawed, because if the numbers don't stack up, no tax structure is going to save it. And that's why in the next video, I'm going to break down the 5 numbers that every investor must know before buying anything. Whether it's your first or your 50th property, these are the numbers that are going to make or break your return, so watch this next.